Good afternoon on a Thursday. We've got Tillman and Dave here to talk about Bitcoin and geopolitics. And it seems Bitcoin is somewhat disinterested in geopolitics given the price action today and throughout the week. That in itself is a compelling story. And so we're going to talk about it here today. Thanks, guys, for being on the show. Dave, I want to get to you because, all of us have been through several cycles at this point. So to me, it's always interesting when we found a new shelf and we range in that particular shelf. We've all been around when that shelf was 8 to 10K, and then it was 20K and change, and then it was 50, a year and a half ago. Actually, last summer about this time, there were all sorts of lives being done about, hey, come join the 58K gang conversation, right? So we were at 58K and we couldn't get above 58K, right? And now here we are.
There was 8 months where people were despondent about the range, and then we broke it and jammed 30+% up in a blink around the election. And effectively, we've had a couple of we had 3 downward thrusts to try to where the top of the old range became support for this range. And for the last 6 weeks, I made a joke. I mean, I still can't believe it will end up being true, but I put out a joke tweet 6+ weeks ago and said, I can't believe this is the last time we're ever going to be able to buy Bitcoin below 100,000. Right. Here we go 6 weeks later, and it's aged way better than I ever expected because frankly, I thought that it was nuts. And, I think I was saying right before we went on air, I thought that I actually believe that if Bitcoin were still an asset confined to the crypto community and people buying it via spot or derivatives on crypto exchanges, that with all the geopolitical stuff that's gone on, whether it is Ukraine attacking, the Russian nuclear capability or the recent, Israeli attacks into and attempting to neutralize Iran's offensive capabilities, I think Bitcoin would have easily been testing that 78,000 and probably made a mockery of that support. Frankly, Bitcoin's volatility would probably have been there. But here we go. Every time there's that mild crypto selling, there's people who are happily lapping it up, like my cat, eats chicken when it's cooked out of the oven, which always amazes me, or eats fish. There's just lots of appetite for Bitcoin if it can be bought without pushing the price up. That's the reality that we face.
Doesn't it feel like just yesterday? For some reason, there are moments where the whole FTX debacle in late 21, most of 22, just feels like yesterday. It just feels like it's not that far away, and yet it's feels like a century away in terms of actual price and price action, right? And it's almost as if we've gotten to a place with Bitcoin that unless there's some sort of market shaking, fraudulent news breaking something, that we're not shaking this particular price action. We're not moving materially down. And when we're talking about U.S. versus Iran, bunker busting, nuclear possibilities, what are their ties with Russia? All versions of geopolitical worst case scenarios, and Bitcoin absolutely doesn't care. Like there's very, very limited movement. We can push down to 103 and change, but pop back right back up.
Well, it tells me that Bitcoin is looked at as a cash equivalent in these types of scenarios. I mean, I would argue that there is no better instrument to hold during these types of crises. It's immediately liquid. It's tradable, OTC, peer-to-peer. It's absolutely fungible. You can take it wherever you want to go, memorizing your seed phrase. Like, there's a tremendous amount of value, I think, in unstable times in finding stability in Bitcoin. I think what's interesting to me is, it's always to me about what is the common mindset as it pertains to potential upside that's left. And it's like if you talk to any XRP holder, they'll tell you it's, $589 XRP. They all have this common mindset. And I think Larry Fink has set that course very clearly with his prediction. And I think when people are looking for leadership as they get into an industry that they don't understand, they look to people like Larry Fink. And if he's saying between 500 and 750, that's ingrained in their mind immediately. It reminds me of the Exxon Valdez oil spill and how big the judgment was, and it was because the jury only heard one number, and it was a monster number, and it ingrained in their mind that that is the value of the damages. And it's the same type of thing here. I think traditional finance, Wall Street is going, this thing is way undervalued, and we're going to accumulate, and we're not going to be stupid smash buyers about it, but we're going to buy chunks as long as we feel like there's a good bit of upside left to be had. And I think we've just begun that. And honestly, if you look at the last peak before Wall Street got involved, we saw a topping out of 78,000. Well, without Wall Street, a bunch of live in the van down by the river Bitcoin maximalists were able to drive it to 78,000. What do you think Wall Street's going to be able to drive it to in this run? I think a 10x from there is quite honestly very achievable. So that would put us at the $780,000 mark. And with that much upside still available and so much liquidity that can be placed into that upside, show me another way where somebody can place several $billion to work without a management nightmare that goes along with it. Like, go put a couple $1 billion into real estate and tell me how much how happy you are with the management of that real estate after 2 years. You can put $2 billion into Bitcoin, have a potential upside of 10x still attached to it, and have no management overhead costs attached to it. I mean, that's incredible.
That's
something
a very big deal. The quote of the day. Oh, sorry. Go ahead.
Something that just dawned on me: most investors, actual investors, people that have meaningful amounts of capital. Let's say it's a 68-year-old guy and he's got $11 million in a Morgan Stanley account, and the other half is in a UBS account. Like the lion's share of those people, by the way, don't fully understand things like futures trading or options trading, right? They've amassed some capital and some wealth, but they don't understand the vagaries of stuff like that. That's the concept I'm going for here. Is I think Wall Street and sizable portions of Wall Street have fully grasped the ethos and the opportunity with Bitcoin, and it's going to go where they decide it's going to go. Even though we look at Google searches for Bitcoin, they're at all-time lows. If you ask even your normal investor, what's Bitcoin about, they're not really going to know. They're going to give you some strange answer if they didn't attend the Bitcoin conference, right? So there's this version where people don't understand or even really care to understand Bitcoin and crypto. A lot of people just think, oh, that's still going. I thought that was over. I thought they put that guy in jail, right? So I think the same thing in the world of TradFi exists as well with are you taking courses to learn how to trade options? Like there's 1.5% of people that have meaningful assets that would ever do that. So they don't really care, but they may have, option-like stuff inside of their portfolio. And I think that's where we're headed, is that even if retail, quote unquote retail, even if the move of Bitcoin searches doesn't dramatically increase over the next year and Bitcoin goes to 200,000, that wouldn't surprise me, because I think the amount of assets that are pressing into Bitcoin, wealth managers, the continued crush of the floor being, spot Bitcoin ETF inflows. I think that's the space where Bitcoin is understood and will continue to be purchased higher and higher and higher.
So there's two things that I want to separate out from what you just said. One is the fundamental way to explain Bitcoin to people, which I believe has resonated. And the other is what Wall Street actually gives a shit about. So let's start with the second one.
Right.
Wall Street doesn't give a flying F what Bitcoin is. They don't care if it's magic internet money. They don't care if it's pixie dust. They don't care if it's magic mushrooms. Doesn't make a damn bit of difference. The single most successful ETF in the history of exchange traded funds was IBIT, and the overall biggest product launch, and it isn't even close. I mean, IBIT alone got to the value it's at now 5 times faster than the gold ETF GLD did. The Bitcoin ETFs are unbelievably successful. RIAs and financial consultants and all the people who work in all the wirehouses and all the big firms are having their doors banged down by clients saying, why can't I invest in Bitcoin? Okay, now I can. Great. I can use these ETFs. What about this other crypto stuff? Why is it all these other people that I've been reading about it and you're having to miss it? And they care about that. They can make money. They care about the fact that the firms have not been allowed to trade spot Bitcoin. So for the first 6 months of this year, or last year anyway, the only way the Wall Street firms got involved was by using the futures contracts to hedge, creating an arbitrage for everybody else. But they were making so much damn money they didn't care. We're talking about enough money to be made by these firms doing it. They saw Robinhood's earnings report, and Robinhood said they made 3 times more money in crypto than they did in equities. Correct. They see this stuff. They don't give a crap about what Bitcoin is. They don't care. What's the difference in XRP? For all they concerned, Dogecoin could be real. They would put money. They would happily let their clients trade Fartcoin if they could make money. They just don't care. And you need to understand that. The old joke was, and I was one of them, right? I spent my entire career, or large parts of my career, before I joined crypto in 2017. I was on Wall Street. I worked for a hedge fund for the last, 2 Sigma, which is a quant hedge fund, incredibly high character place, incredibly disciplined approach, one of the 2 arguably greatest investment companies on the planet in terms of overall results. There's like 4 that always get mentioned that breath: Renaissance, 2 Sigma, Citadel, and and there are different things for all of them, but arguably 2 Sigma is one of those great places. But 2 Sigma, would trade anything if they thought they could and make money at it, and they would get data from anything. We had back then, that was 8 years ago, they had petabytes of data. They were looking at electricity data, regional electricity data, as indicators for trading all sorts of different assets. I mean, they would do just about anything. That was before people even were thinking about that stuff. So I can't even imagine how much data they have today. So that company was doing what it could do. I worked for Citigroup, via Solomon Brothers back in the day for a 14-year period before that. And I can tell you, they would trade literally anything if they could make money at it, and do so without taking legal or reputational risk. Legal or reputational risk, however, became a bugaboo when we had Elizabeth Warren shaking her fists at Wall Street and saying, don't you dare, to her pet Gary Gensler, don't you dare let them touch these products because we don't like them. And so all of Wall Street stayed away. That is the only reason all of Wall Street stayed away, because they were threatened, and that threat had teeth, because there is literally no way. This is something people don't understand. I mean, you see in crypto Twitter all the time, people going after Citadel. They say, oh, look at Citadel. They got investigated by FINRA, and they had this thing on their broker check report. Well, let me tell you something. I run 3 broker dealers. It is literally impossible for an investigative team to come into a broker dealer and not find at least one something. It's like, imagine a world where you had the little bot in your car watching you, and if you go 56 miles an hour on a highway, you're considered a traffic offender. Now answer me this, Batman. How many people would not be traffic offenders? In fact, everybody would be, because that's exactly the situation that we have in our securities laws. So they were pushed out. Now they're allowed in. They're not allowed in yet, but it's very, very close. And they are all getting ready for it, because the certainty that they will be allowed in is as close to 100% as you could possibly be. You couldn't even get somebody to make money on Polymarket. I don't know if you saw the ridiculous like $2 million plus bet someone made to win like $50. I mean, it was a small amount of money betting the Fed would do nothing yesterday or Wednesday. It was yesterday because it was like 99.99%. I don't think you could even get a bet on whether or not Wall Street firms will be allowed to offer crypto trading services because the head of the SEC has basically said that he wants them to be able to do so. And they just put a good friend of mine who is phenomenal, Jamie Selway, to run trading and markets to help them write rules. He, however, has an incredibly full plate, having the SEC just withdrew 14 different rules from the Gensler administration, which they're formulating replacements for some or streamlining for others, and some they're just going to abandon because they were stupid in the first place. But so that's going to happen. And the reason that I have this new background and it looks more professional is in addition to you guys, I'm working with a couple of firms that the TradFi firms are going to need. I mean, CoinRoutes for routing and algorithmic trading, and Solidus Labs for cohesive compliance monitoring across asset classes, from crypto to bonds and equities, of course, in the middle. And so, I am working with firms that can do that. That's why it's there. But that's the first point. So that just kind of says what you say and puts it in there. Now, what does that mean? And I'm going to get to the second one, which is why Bitcoin, because there's something I want to talk about. But what does it mean? Well, anyone who's traded, and look, I've traded for years, right? I know how the risk management systems are written. I know how the algorithmic trading systems are written. Mostly because I wrote one of the first ones for trading volume weighted average price. If you look at the most popular algorithms that are used by institutional investors for trading assets are volume weighted average price, are participation at a small percentage, no more than 5% generally, right? It's not that small. 5% is pretty impactful, but 5% is probably the top end. And opportunistic algos that will run for days at a time, that will kind of float with the market and get liquidity or take liquidity when it can get liquidity and be sitting in dark pools for people to come against. Those are the three most popular. What is the feature of all three? Well, the participation algo is probably the most aggressive, but it's not used the most. So the participation algo, the one that says I'm going to be 5%, watches volume trade. And as volume trades, it says if it's falling behind, it will accelerate. That one is for portfolio managers who are like, we have high time preference on the establishment of positions. So that's where that gets used. Volume weighted average price is like, listen, we're going to put whatever we can put to work. We have models that tell us what we think we can buy, what's investable. That's your point about investability, right? Mm-hmm. Which is obviously much more for Bitcoin than it is for, whatever, Dogecoin. But the truth is that they do that for every asset. And you have the opportunistic ones. The ones that get used the most by people who have low time preferences is probably the opportunistic, followed by VWAP. What happens when you get people who are trying to put money in Bitcoin? Well, put yourself in the shoes of the CEO, GameStop. And he doesn't want people to yell at him. So he wants to be buying consistently. And I heard that one of the two of you said it. I was listening. I wasn't watching, so I don't know which one of you said it on a show recently. But the reality is the last thing he wants to do is market buy with a huge percentage of his cash hoard and have it drop. And Bitcoin has been known to drop. It's volatile. So he's going to be much more slow and steady. And so you now mirror that across all these other companies and all these other FAs. And what you end up with is a fairly interesting dynamic. Whenever there's weakness, so it's at the top of the range, it starts coming down. Well, there are people there who have algos that are buying. When it starts moving up to the top of the range, the volume drops because they're not following behind them. I call this the Wile E. Coyote market. If you run over the cliff and you're running in that whatever, then you look below you and say, oh, people didn't follow me. I ran out of space, and it drops again. You see a lot of that. And so, but it's the nature of the algorithms that people like that will use to accumulate Bitcoin will mean that any mass, impulse higher can only happen in one of two ways. And generally it both happen. One, FOMO inside the crypto community. Then you're going to see Google searches up, then you're going to see leverage go up, then you're going to see all that stuff. FOMO in the crypto community will absolutely take it beyond these levels. But is that likely to happen from this sort of a base? And the answer to that is probably no. But what is also likely to happen is at some point the selling in the crypto community abates. And when that happens, then those who are trying to passively accumulate can't passively accumulate anymore. So if you think you're going to buy, pick a number of your company, you think you're going to buy whatever percentage you are, $10 million worth of Bitcoin, and you're buying it really slowly, and you're buying 100,000 a week, and the price isn't moving. What happens to you when the price starts to break outside of its range?
You're moving faster.
It's moving higher. What do I do?
Yeah.
The point upon which game theory starts to kick in. And that's where I think we will get to in the third and fourth quarters of this year, once we're past summer seasonality, if we don't see a major stock market correction.
Yeah, it really is something to look at today's volumes, right? So it's a Thursday. A large portion of the general public and even the retail investing public don't even realize that broader markets are closed, TradFi markets are closed. There's a lot of people that aren't aware of the Juneteenth holiday. And so in previous market cycles, both overnight trading for Bitcoin and holiday trading for Bitcoin was robust because crypto is the only thing you can trade right now, right? So because retail was the dominant factor in crypto, evenings and holidays and weekends, you saw, significant price action. It looks like the price action today looks like overnight. It looks like everybody's asleep. It looks like a Sunday and it's Father's Day, right? There's literally nothing happening. There was a move that approached going underneath 104, but the minute that it did, it went right back up. And that's the only meaningful candle today, both on volume and on price. But if you look at it closely enough, it's like, Bitcoin moved $800 while it's at 104,000, right? Like that's not even meaningful price action. It just looks like it because the chart's so compressed. So again, what do we do? What does it look like tomorrow? Who's back in the market tomorrow and reacting or not reacting or making decisions based on, what they think are meaningful associated with short-term price action. And we'll probably find ourselves really looking at, what happens Monday at 9:30. And therein is the new ethos of Bitcoin. What happens Monday at 9:30? Because that's when the volume kicks back in.
Yeah, look, there's a few things that I wanted to get to. One is I thought one of the best comments I've heard recently was a guest, the guy from Ledden, Maurizio from Ledden, who's a Bitcoin landing platform. He made a point this morning, which I will call it the Copernican view of asset prices. He didn't phrase it that way. I'm phrasing it that way. What he basically said is everybody who's been buying real estate for years have effectively been subsidized by the government to short dollars. Because the reason real estate is up as much as it is the dollar's financial ability, financial worth has been melting. And we've done a good job because productivity has created disinflationary or deflationary pressures from having that the dollar decrease translating to consumer prices, but it certainly has meant asset prices have exploded. But if you think about it, Bitcoin is a far purer way of doing that. Because unlike house prices, which have at some point to be tethered to affordability, right? At some point people have to afford their house. Just like stocks have to be tethered to some percentage of revenues or earnings.
Right.
Not always. I mean, some. Hell, we were seeing it. Stories.
Circle.
Circle can't be justified at these levels any more than a lot of other companies can't be justified at these nosebleed levels. But if you believe they're going to grow into it because stable coins are going to become the biggest thing, it's worth talking about that. Heartbeat, whatever. But Bitcoin, as the dollar and really all of fiat melts because we're constantly printing more of it, you have to express that. But the thing about Bitcoin that's really interesting is if you just want to bet on the dollar melting, okay, you can buy gold, you can buy real estate, you can do whatever. But if you want to bet on the dollar melting being recognized by people, and you say, what do you mean by that, Dave? That people realize that this is a big deal. Then the asset that they are most likely to buy is going to be Bitcoin. Bitcoin will not just rally in dollar terms, but also rally in the network effective acceptance. So that network effective acceptance will arb out the 90+% discount that Bitcoin trades to the monetary value inside gold.
Well, and I think that's because if you look at real estate as being kind of the previous indicator of that, it's always attached to a monster debt service number that doesn't, you don't have that same dynamic in owning Bitcoin. So if I'm going to have, to your point, I've got to afford the debt attached to my house. And so that naturally inhibits the value of real estate going on, essentially escalating at the true inflation rate. Whereas Bitcoin, because you can hold it with no cost of ownership, it allows you to scale it infinitely, even at an individual level, right? At an individual level, it is impossible for me to manage 10,000 apartment units. I would have to hire staff. I would have to have lots of banks that I have to deal with. There's meetings all day long, every day, all day to maximize that type of an endeavor. I can get the same amount of capital placed into Bitcoin, scaled into Bitcoin, and have zero management and overhead cost attached to it. I think that absolutely, in my opinion, raises the ceiling as it pertains to where Bitcoin's going to go. And like you said, I've been saying this for a long time, it's the purest indicator of inflation globally that man's ever created. Like, we've never created something that is a better dashboard indicator as to what the M2 money supply looks like at any given point in time. And it doesn't take a genius. You look at the two charts and put them on top of one another, and they're almost identical, literally.
Right. And the real question will be, when will Bitcoin break out of that towards that, achieving that network effect? And we've had lots of conversations about that because there's implied optionality. Now, one other thing you said, Andrew, the one thing you said that's just not true, and I want to point it out, and it kind of goes toward this, is you made a point about options, people not taking options courses. By far, the most successful product before the Bitcoin ETF, but the most successful financial product, the one that Wall Street's making the most money on, it's literally one of the most absurd products ever. Is same day, one day, S&P 500 options.
Yeah, sure.
It's a massively popular product that retail. Sure. I know you know this. I'm not saying it this way. What I'm saying is retail loves to gamble. And so options are there. But here's the thing that's going to be really fascinating, and really fascinating for you guys, is retail loves to gamble, and options are incredibly profitable, but for Wall Street firms. But understand that options are unbelievably expensive as a means to gain leverage, to the point where 80% of all option premium ends up expiring worthless, right? Market makers make a lot of money taking the other side of retail option trades. And I ran a retail broker dealer that took the other side of stock trades, and we made money, but we weren't even in the same zip code as the dudes who are on the other side of retail option trades, because most of those option trades are just paying spreads that are through the nose, just through they're paying through the nose. Whereas
I think
there doesn't have to do that. Because perpetual swaps don't charge that much.
My point is that the lion's share of wealth management clients are not sitting at their desk or on their phone throughout the day hammering away at options plays. They're just not, right?
No, but I will say this. One of the things that has kept Bitcoin in this trading range, and one of the things that will cause it to causes volatility to spike when it breaks out of the trading range is MSTY, if you knew where I was going.
Listen, I think options. Yeah, I think options will end up playing a meaningful role in Bitcoin price at some point over the next 2.5 years. I think, Jeff Park has talked about the possibility of a gamma squeeze at some point. And given the way that Bitcoin ETFs function, there being a gap in, the movement of Bitcoin, there's a lot there that could happen. And given, again, Bitcoin is a 24-hour tradable asset, never turns off. And so, options, there will be a moment where options play a meaningful role in the movement of Bitcoin price. Some would say that it's playing a meaningful role right now in terms of the muting of quote unquote volatility. That's probably true. There will be a point where the reverse will be the case, where it will exacerbate volatility. So we'll see when those things happen. But my point about the concept of Bitcoin has been embraced, no question, by Wall Street and Wall Street's biggest clients, meaning BlackRock. And again, by the way, this is true. BlackRock's product is not easily and very quickly available for all wealth managers across the country. It is still a fairly siloed product. It has still not been, approved no matter what at, UBS or Merrill Lynch or Wells Fargo. It's still siloed in the highest of silos at those places, where you have to be an ultra high net worth client, you have to be in their private wealth space, and you have to request it. Okay,
yeah, that last one is the key.
It hasn't changed. Yeah,
that understand non-solicitation.
Yeah,
the instant that Bitcoin products can be sold by financial consultants who are allowed to say, you should put some of this into Bitcoin. They're not allowed to say that right now in a lot of firms.
So I would even go one step further and say then the final step would be where it goes from an opt out to an opt-in, where it automatically is included in, your default. I heard at the Bitcoin conference, if I heard it one time, I heard it 100 times, the 60-40 portfolio is dead. So if that's the mantra that they're carrying around, the TradFi guys at the Bitcoin conference, it's only a matter of time before that essentially permeates throughout the entire system, and you start seeing the defaults being a 50-40-10, right? And the 10 being Bitcoin. And I think 10 is probably an aggressive number, but I don't think it is 7 years from now. I think it's
a predictable cascade of availability as an investment, right? So BlackRock gets in, and these other institutions get in, and the system says all of your institutional clients can get in now. So all the institutional clients that BlackRock has, they can ape in and buy it down in the 40s, 50s, and 60s, right? And then there's another version of it. Okay, now we're going to let the PWM divisions of Morgan Stanley and others, now we'll give it availability to people that have 10 million or 25 million or 50 million long at the firm. And it hasn't gotten to even retail guys with $4 million accounts at Morgan Stanley. It hasn't gotten there. So we're still waiting for even that moment. And so that's my point, is that most of BlackRock's inflows are not, mom and pop or Steve and Sandy Smith that are putting it in their portfolio. It's, some institutional client that continues to put money into the IBIT product. And that's where, 65 billion of the 75 billion that they've got in that product has come from. Again, retail and Dave knows this, right? In the world of wealth management, there are basically three sections of clients. There's ultra high net worth, which are generally 25 million plus. There's high net worth, which is 2 million to about 10 million. And then there's mass affluent, which is like 500K to 2 million. So we've kind of broken the seal on ultra high net worth. We have not broken the seal on high net worth, not even come close on mass affluent. So there's an ocean of capital still waiting to go into those products.
Have you guys, do you know who Mercer Consulting is?
Mercer?
Yeah. So
I've heard of it.
Okay, so let me explain. So there's an entire industry. Mercer is the largest, but Mercer alone advises somewhere in the neighborhood, mostly based on AI, they're estimating around 17.5 trillion, that's trillion with a T, of pension fund assets. And they are the ones who help pension funds determine what's the model portfolio. And yeah, they have growth and value in this and different allocations. And they have a fancy formula that relies upon that tries to deduce based upon their asset liability match and underfunding amount. So therefore the amount of risk they need to take about what that portfolio set should look like. But here's the point. Mercer and their cadre, there's other firms like Cambridge, and there are a lot of them, and I don't know who they all are now because at various points I've dealt with it, but we're literally talking about the lion's share of pension assets. And in their world, the world breaks into two pieces: investments and alternative investments. Right now, Bitcoin and crypto is an alternative investment, and it gets the crumbs off the table.
Yep.
The instant the Mercers of the world, the Cambridges of the world, consider Bitcoin as part of investments, i.e. part of the 60-40 portfolio. It doesn't be 60-40, it could be 95-5. It doesn't matter what the numbers are. But the instant it's there, it literally opens up the world and probably opens $50 trillion of investable assets to being available to be put into Bitcoin. Now, curiously, BlackRock's model portfolio already has it that way. But BlackRock doesn't. They are used by pension funds, but they are not market leaders in the determination of pension portfolios. And so when I make the point that we have a long way to go, we have a long way to go. But the biggest single flip of a switch is either one of two things. It's either sovereigns, because people realize that Trump is serious and the U.S. is actually considers Bitcoin as a strategic asset, or the pension fund consulting industry, which advises the biggest funds in the world and most of them, that they really need to be in this asset. And it's not an alternative investment, which is kind of the crumbs at the table. I don't know when that will happen. My best guess is it happens when Bitcoin crosses between 5 and 10 trillion in market cap. What did I just tell you? I just told you that when Bitcoin goes up in price to a substantive amount, enough for the pension consultants to not be able to ignore it anymore, it's going to be like the second stage or third stage of a rocket.
Well, you just told me is once we hit 250,000, that's what pushes us to 750,000.
I don't know what the numbers are. The numbers could be it's from 500 to 1.5 million. I literally don't know, Tillman. I'm not speculating. I'm not being tongue in cheek. I don't.
Well, I know, but I'm just doing rough math.
It is absolutely 5 trillion on the journey from Bitcoin between here and $25 of digital gold, which is somewhere around $1 million. In 2 years, I expect gold's going to be at a much higher price than it is today. So Bitcoin, therefore, its upper bound from just in the conventional system is higher. And we can debate it. I don't want to debate what will happen because I don't want to debate something when I don't know what the world situation is going to be like when it happens.
Too much changes in a day.
Give me a 90% discount. In my entire investing career, I've never seen something that I believe is north of a 50% probability to be worth 10 times as much as it is today. I really believe those numbers. And so you do that number, to me, it's like investing money that you don't need for the next 5 or 10 years is like the ability to put all your money in a tournament on pocket aces pre-flop. Now you don't always win.
I even think that the odds have been skewed greatly in your favor based upon the concentration of capital that we've been able to accumulate. Thus, I mean, I think Bitcoin's been de-risked compared to, what you could get a 10x at a lot of different points in Bitcoin's history, but to get a 10x at this risk profile, I would agree with you. I don't think global finance has ever seen an opportunity like this or have seen it recently.
No, and that's the reason that you have so much momentum, in Washington for doing something that sounds incredibly risky to people who look at it. And it's like, well, it's because it's a self-fulfilling prophecy. I mean, I don't like the way that Senator Lummis has portrayed it. I think it's over promising. I always like to under promise and over deliver, not the other way around.
Yeah.
But the truth is, if the U.S. were able to accumulate a million Bitcoin and then told the world they had done so, what happens to the price?
Yeah.
Right. It becomes a game theory nightmare for people who aren't involved. So, there's a lot of reason to believe it. Do I change my opinion if you told me the U.S. will never do it? Well, no. The U.S. never and should have never opened up retirement accounts or the Social Security or anything to stock investing ever. They've been investing in a melting dollar the whole time, and so and stock market's done just fine.
But how much do we consider as Americans kind of the national interest of national security as it pertains to discovering and securing rare earth materials, for example, or silicon chips, for example? Like those are things that we can't allow to be outside of our control as a market maker. And I would argue that Bitcoin is that as well. And so if you look at it from that perspective and what it could, if there's an ability to create a self-fulfilling prophecy for the US, then it has to be true for all other nation states, right? It has to be true for Russia. It has to be true for China. Anyone who grabs this proverbial bull by the horns can take over that market and recognize that. Well, out of self-interest in protecting the powers of the current world global system, we have to do it, I would argue. No different than if a country was able to corner the market on silicon chips without being checked. That would be of global interest. That would be something that we would have to protect the interest in, because the concentration of it is of threat, is of massive threat. And I would argue Bitcoin's the exact same thing. I mean, if we don't corner it, the question will become who will. And if it's a self-fulfilling prophecy, when that amount of liquidity flows into the market, then do we want to let that genie out of the bottle if it's an evil genie? No, we don't. Well, therefore, we have to be the good genie. We have to pump the liquidity in to take that position because, we don't want the devil we don't know, essentially, in that spot.
Yeah, no, I think that's actually very correct. And when you look at the intersection of a native digital currency that can be used by AI agents, you get a very short list, right? It's so look, there are two products that have achieved product market fit in the world of crypto, right? There's Bitcoin and there's stable coins. One could argue stable coins have a bigger product market fit. That's because the world, if you believe my worldview, should be saving in Bitcoin and spending in fiat. But the world does 100% spend in fiat, and there's still quite a bit of saving in fiat. You can argue about that as much as you like, but that's just reality. And people like John Deaton, who have publicly announced 80% of his net worth in Bitcoin, are obviously saving in Bitcoin. I am in a similar. I don't know how you qualify me, because so much of my net worth is tied up in my own company, which of course is software for trading crypto and predominantly Bitcoin. So I don't know what number you associate to me, but the truth is that if that's what you believe, it makes sense. The vast majority of the financial people in the world would think that John and I are crazy. Now, a lot less of them think we're crazy today than a year ago. And a lot less still will think that we're crazy in a year or 2 years or 3 years, and that number is going to keep dropping. But the fact is that that's not conventional wisdom. At the point where it becomes obvious that saving in Bitcoin is part of everybody's strategy and is normal, the price is at least 10x where it is today.
I would agree.
That goes to my point about where we're at in terms of retail and where we at in terms of who has decided they are going to understand Bitcoin in some sort of way or are not going to understand. That's where we are right now. To your point, the majority of people think you and John Deaton are crazy, other than the BlackRocks of the world, the Bitwises of the world, the sovereign wealth funds that are sniffing around, or treasury companies, or whatever it happens to be. There are people that have decided that over 4-year cycles, Bitcoin doesn't go down. And so, okay, whatever the tech, whatever the conversation we're having, we're going to allocate to this. And that's a different conversation than where we're at with, quote, those 3 levels of retail, right?
The crazy part to me is why is there such harsh judgment on people having 80% of their net worth in Bitcoin when there's no intrinsic risk to holding it in terms of a cost or a cash flow perspective? When there's intrinsic risk,
there's lots of risk. If you're Mike McGlone, who I argue with every week on Monday, Mike will look at the Bitcoin's volatility going back over 10 years, et cetera, and say, well, look, on a risk-adjusted basis, it's extremely risky. Well, that's true. 10 years ago, Bitcoin was 100% speculative. Today, it's probably, 70% speculative. Bitcoin 10x's in price, it might be 10% speculative.
But there's no
where we are, but here's
the point I'm trying to make is there's no catastrophic risk in terms of going bankrupt from a debt service perspective, and that is not true. That's not true in every other asset that you hold. Essentially, if you're heavily involved, people don't get scrutiny if they have 80% of their net worth in real estate, and all of that real estate has 80% loan to value ratio. But if you have 20% loan to value ratio, there's a lot different calculation there. There is no calculation needed for Bitcoin. It is a debt-free asset that if you hold it in your possession without leverage attached to it, the only risk you have is it going down. So here's my point. Dave, you owning 80% of your net worth in Bitcoin, well, if the 20% that you have left in liquid cash, based assets, if that can pay, if you have no debt to service and you can basically live off of that or the interest of that going forward in your life, then I would argue the 80% that you have in Bitcoin is a much more effective vehicle than having 80% in real estate, even debt free. Because even if you own the real estate debt free, you still have property taxes and maintenance and upkeep costs. Like, it's still a better asset is the point. So I think
I was going to say, just for the purpose of being fair and honest, my number, I exclude real estate. The house I'm sitting in is my second home. I own it, 0 mortgage. It's a beach house on Long Beach Island, New Jersey, so it's obviously not value less, but I have no debt whatsoever on it. But of course, I just found out this morning my pool heater is going to need to be replaced next year. We had to replace all our decks last year, and the upkeep is non-trivial, at the shore. But I exclude that from my own thinking about net worth. Now, it's probably not the right way to do it, but I'm inherently conservative, which I know people.
Well, I'm just saying that can't apply at scale without thinking about it.
You
can do it on a 1 or 2 off, but you can't scale that without thinking about it.
Right. But a lot of our viewers are playing in hyperliquid and or in derivative exchanges, and when you see the amount that goes, there's a lot of people who leverage quite heavily in Bitcoin. And I'm always worried. I'm always cautioning people about that, because whenever you do so, there's always the risk that you pyramid and you get liquidated and you get wiped out. It is a serious risk if you're not smart about the way that you do that. Now, if you're taking 5% of your portfolio and you're levering that up and that's a loss limited and you get that liquidated, do you really care? Well, obviously you care, but it's not that big of a deal. But if it's 100% of your liquid net worth, well, then you're foolish. And you don't want short-term volatility that will wipe you out. And so Bitcoin does have that risk. That doesn't happen in real estate for the same reason it doesn't happen in private equity. It doesn't get marked to market. Right. And whereas Bitcoin does. So
it's something. I mean, interest rates going up or down have the same type of catastrophic powerless effect. I mean, if you're holding a bunch of debt that's at a variable rate, and all of a sudden geopolitical causes drive interest rates up, you're an extinction event. It reminds me of, listen, there's times in Houston where everybody knows the producer's cost to produce. And like, I'll give you an example, like back in the 80s, there was a time where there was a very notable guy in Houston and everybody knew his cost to produce was $10 a barrel. And we all knew if the price went below $10 a barrel, he was bust. He time to shut the wells down. You see what I'm saying? So you essentially, the same thing applies in real estate. Depending upon your debt structure, depends upon what risk you're really taking. And ultimately, there is catastrophic risk for everyone in that industry because no one has fixed rates on all of their properties. There's a variable rate that's attached to every growth curve if you're leveraging up in the real estate game.
Yeah,
what do we think about this comment? Because there's two ways to go about looking at it. One, in terms of a cycle top, I think that's possible. In terms of Bitcoin top, a top of all tops, that's never going to happen because Bitcoin always goes higher every 4-year cycles. So, do we think that Bitcoin price finds a meaningful top end in November of this year? It certainly did to some extent this past November. That's when it really began to move. Your thoughts, Dave?
Look, my thought is straightforward. I hate comments like this, not because there's no rational. So the notion of a cycle top, fine. I mean, it's really the political cycle that matters. And I think the political cycle top this time is going to be driven by the likelihood and when poly market is getting to something definitive on the midterms in the United States.
Yeah.
So November of this year is way too soon for a political cycle top. And the 4-year cycle from a halving cycle perspective is pointless at this point. And when I say pointless, I mean the math makes it pointless. You can talk about anything you want, but the math is we got going from 450 to 225 Bitcoin mined every day in rewards is a de minimis difference. It doesn't fucking matter anymore. Going from when it was, going from 900 to 450, did it matter? Yeah, but now the ETF world is mattering less. Going from 1800 to 900, did that matter? Yeah, that mattered more. Going from, and you're getting the joke from 36 down to 18, that mattered a lot. And so it's getting less and less important. So the notion of a 4-year cycle based on Bitcoin mining or halving, I think, is irrelevant. Obviously, it's not irrelevant. There's a marginal difference, but that marginal difference is not going to be enough to move the price. The price, however, in Bitcoin is in large measure going to be tied to the political cycle. If it looks like we're going to get all progress is going to stop on what's going on in the Bitcoin world, the crypto world, the Bitcoin innovation cycle in the United States after 2 years, then that could cause a meaningful cycle top. On the other hand, if it looks like it will continue for the full 4 years, our cycle top will be as we start approaching the 2028 election. So I think to call a top without regard to where the price is silly. Now, that said, if we get a rally in the fall that takes Bitcoin to, without anything else major changing, to over 300,000, and we're at the same level of exuberance that we are relative to the Bitcoin network that we were when it was in the 60s, and we start seeing at the same time leverage on perpetual swap exchanges, people paying 25 to 50% or more per annum to go long Bitcoin, and we see Bitcoin treasury companies trying to outdo each other by how much leverage they're taking, and we're at that really high level, absolutely there could be a cycle top right then. I don't know when the date will be in that, but when we see that, those are the neon flashing red signs of a cycle top. But until we start seeing excessive leverage and excessive exuberance, I hate making those calls because I think the political cycle, which is also 4 years, although with a little bit more nuance to it, is more important than the halving cycle. So that's sort of the way I look at that. Doesn't dispute the gentleman's post. He may very well end up being right, but for different reasons.
I don't agree. I don't agree that there will be a top. I think that the 4 year mining cycle, if you think about why the miners controlled the price for so long, well, they were the only supply. That is where Bitcoin is birthed. That is where the supply and demand curve, where the rubber meets the road. I think the supply and demand curve is driven by Wall Street, and I think it's a rising tide, and it's going to float all ships, and I think it's going to float it to eternity based upon the M2 money supply. I think the new 4 year cycle is now this infinite inflation cycle that is measured with how much liquidity gets pumped into the markets. And I think you're going to see more liquidity pumped into the markets in the last 2 years of Trump's office than in the first 2 years. So that would tell me that the blow off top wouldn't happen until well after that capital has been exhausted, which would tell me, we got a long way to go. That's just my simple, if there's money out there, listen, it's the old. I went to University of Texas. I went to finance. I got a finance degree, and the university, yeah. And one of the things they teach you is the consumption function. If you have the money, you will spend it. That is just like period. The end.
There's a very important point you just made, Tillman. And I've said this, I've been saying this, I haven't said it for a bunch of months, but something that I made very clear. And Secretary of Treasury DeSantis has said the same thing, although he's walked it back recently, which is this administration doesn't really give a shit about 2025, but they care a lot about 2026.
Yeah.
So what is that telling you? That's telling you all of the rhetoric about that all the attacks and the wearing and the pain that they're going after Powell because they want to get one of their own in. Dr. Donish, who I don't know, you must know him because he does Twitter Spaces with us and whatnot. But his theory is there will be a shadow Federal Reserve Chairman appointed, waiting in the wings within the next few months. And all of this is sort of like when your kids start wearing you down. There's a famous Simpsons episode with I want to go to Mount Splashmore. They're trying to wear it down so that you will get easy money at the same time as stimulative policies going into the midterms. Now, Powell, and this is where his credibility got destroyed, Powell clearly tried to help Kamala in retrospect. And only the bond market stopped it from being terribly helpful by cutting 50 basis points right before an election. There's very little doubt that something similar is going to happen in the midterms because it won't be the presidential election. I think it's way easier to do it in the midterms than it is in the presidential cycle because it's less obvious. But we'll see. But I do think that all signs point to a liquidity deluge next year, which is another reason that, markets might very well react before that deluge, and it might be a buy the rumor, sell the fact kind of deal. But that's why November feels too early for me. More like next spring feels more, if you're going to talk about a political cycle top, that's really the time I would think. But so many variables. It's sort of like, we're not Harry Seldon. You get the reference, you ever read Asimov's Foundation, Cycle History. He says he can predict things, that you can predict major trends, but trying to get everything right, it's not working.
Yeah, no, it's the list is long and distinguished. People that have, put together price and time predictions with Bitcoin, and like 98% of them have all been wrong, because either Bitcoin gets there faster, or the timing's wrong, or whatever it happens to be, you end up being wrong. Bitcoin has made fools of all of us at one point or another, because we think something's going to happen, then it doesn't happen, or oftentimes the opposite happens.
Can I make a point that's more self-serving for you guys that you probably don't want to make as much as I do?
Yeah.
I would generalize that comment that markets make a fool of us all the time, which is why that algorithmic solutions such as Arch Public are so important for the average investor, because if you start letting your emotions and what you think and all of these things that we talk about determine your micro investing decisions, inevitably you're going to be wrong more than you're right. and you're going to miss out on what you're trying to accomplish. And so, people ask me, they go, why are you doing shows with these guys? I mean, it's a retail platform. You're not in retail. I'm like, well, I may not, but I talk to a lot of retail people every day. I'm going to be a crypto town hall or with this or whatever. I think it's really hard for the average investor to understand the simple question of, I have X amount of dollars. I want to put it into this asset. What's the best way to do it?
How do I do it?
Yeah. Answering that question is such a different question than most people think about. They think, oh, I'll just buy it when I feel like it. It's like, well, okay. I mean, do I want to buy it in a market that's doing like this? Where do I pick my time? Well, if I have a piece of technology do it for me, I do a better job. And that's why it's so important.
It's really working through some level of cognitive dissonance with retail investors, because they see, Saylor put out on a Sunday evening another dot plot, knowing that another announcement's coming on a Monday morning. And for some reason, 90+% of retail is thinking that Saylor at some point in the last day or 2 or 3 just said, I just bought $1 billion of Bitcoin.
I want this to be very clear. So Saylor, maybe he isn't doing it today, but I think he is. When he started, and for a very long time, he used a company's algorithms called Tagomi that happened to be bought by Coinbase.
Yep.
I know this well because CoinRoutes and Tagomi and Talos were the 3 companies that are crypto native companies that provide algos. I co-founded CoinRoutes. Tagomi's co-founder, Greg Tussar, is a friend of mine who is a brilliant guy. And that's what Saylor uses. When you use algorithms like that, you have an order. That order sits in an algorithm and it pieces it out into the market intelligently. And without getting into lots of detail, it does so in a very cheap manner. Yeah. That is a different problem than a retail investor who does not have a specific amount of money to invest in a specific time period. Right. So there are 2 sets of problems. Correct. Problem set number 1 we were talking about is for retail, where, okay, I am going to have this income stream and this investment stream, and I can spend the next 2 or 3 weeks and put this in, and I can dollar cost average, I can do whatever I'm going to do, but I don't have constraints. My constraint is, the biggest constraint you have is when your finger pushes the buy button or when your brain says I should do it. But in almost every case, every professional will tell you, automate that and take the emotion out. When you're Saylor, you have a very specific thing. He has amounts of money he is allowed to trade in very specific time windows when he has to do so. Those are different questions. But here's the point. The average person, there are people in the crypto world who still believe that Saylor trades OTC. And when you trade OTC, you don't create market impact, which is the dumbest thing that it always makes me question the IQ of the moron saying it, but I hear it all the time. What do you think the OTC guys are using? They're using technology like Tagomi or CoinRoutes or Talos to trade this stuff, or their own version of it. Everybody who's professional uses algos, and those people all have specific risk parameters at a particular point in time.
Again, that's my point about cognitive dissonance, is that retail, for some reason, they can't get their heads around that every big investor that they either look up to or would like to emulate, or I wish I was them, are all using these tools, and they don't think I want to use these tools too.
Well, I can prove it to them. Yeah. It's very easy to recognize, and here's how you recognize it. You take the biggest asset and then you look down the chain of correlated assets, okay? So Bitcoin being the biggest. And then I don't care which coin you pick down the list. Pick number 100, pick Fart Coin, pick Flare, pick any of them and watch when Bitcoin dumps, how quickly the rest of them dump. It's not a bunch of people sitting by the computers going, okay, let's get Fartcoin down to 2% because Bitcoin's down 2%. Let's hit enter. No, it's this chain reaction of instant execution across every single asset. And that, if it's very, very easy to see. Watch how the traditional finance markets dump in unison with one another. It all happens simultaneously because it's all just computers executing on dump.
I mean, it's the stuff that
It's
you
not the
see.
meme where what was the French guys that had the phone call and they said dump the markets, and then you saw the giant red
Yeah,
candle. You know,
those twins that had so much plastic surgery, it was uncomfortable. Yeah,
exactly. Yeah.
It's
Camping
very, very
or
true. But the
something.
point that I was trying to get at is anybody who asks the question, how do I do this? Should immediately, if you have any meaningful amount of money to you. Now, meaningful amount of money does not mean, I want to be really clear. I'm not talking about losing 10,000, 100,000, $1 million. I'm talking about meaningful money to you. So if $10,000 may not sound like a lot, but it can be extremely meaningful if invested over the course of a couple of years, 10 years from now, could easily be incredibly meaningful. And guess what? The way you invest it now will ultimately have a multiplier effect. If you believe Bitcoin is going to 10x, which I do, then every dollar that you save now is actually worth $10. So it magnifies that. So it's very important to consider these things. And I just was making the point because, obviously you guys have a product and you have clients, etc. When you have clients who understand that you have the ability to do things in a incredibly professional, disciplined manner, that is the secret to where most of the big investment managers have made their money. And you could go through and look at all the major ones who have done really well for clients and for themselves, who have succeeded. They all have a couple things in common. One of them is a disciplined approach to the way that they actually execute. Right. It's almost universal.
Well, that's the problem. It's just like the scalable problem on the real estate front. The more capital you're trying to place into the markets, the more difficult it is to place it without moving the markets. And therefore, you need to break it up into a lot of different chunks and strategically place those orders. And if you don't have a management tool to help you do that, you're dead in the water. You can't do that in a manual way. It's impossible.
Right. So it's every time I get that question. So I was asked that question on the boat today. The captain who was teaching me how to. I joined a boating club, and so I was getting my a lesson today on boating, and I learned quite a bit. Actually, he was phenomenal. But he actually said to me, "Oh, crypto." He's asked what I did, and I told him, and so he said, "Oh, crypto. The only thing I did is so a buddy of mine told me to put $500 in XRP, and now it's only worth $434. Should I sell?" And I looked at him and I said, "Well, look, I own some XRP. If you ask me if you're going to have an X amount of money to invest, where would I invest it? I would put it in Bitcoin. If you ask me, do I have, do I want to screw around with other investments? The answer is fine. But, it really depends on how you're going to do it." We had this whole conversation and I just said, listen, whatever you're going to do, it's always best in some sense to dollar cost average. And depending on how much, there are tools out there, and I'll tell him about you guys, and he may take you up on your offer. I don't know. He may have just been humoring me. I have no idea. But the truth is that it's funny when you hear these stories. I've had so many people say to me, "Oh, crypto? Yeah, I got really interested in," and Scott always talks of this. I was interested in that doggy coin that Elon likes so much. I hear that a lot too from average people.
Well, listen, it goes back to like when your grandmother's talking about Bitcoin, it's time to sell. Like my dad has an old saying about oil and gas deals, and in my youth would bring him an oil deal that I had heard about, and I'd be like, "Hey, can you tell me all about whether this is good, bad, or indifferent?" And he wouldn't even read it, and he'd go, "Oh, that's not worth doing." And I'd go, "How can you tell me that? You haven't read it?" And he goes, "Oh, because it made it out of Texas. If everybody in Texas passed on the deal and it made it to your desk in Tennessee, Tillman, it's not worth doing. I promise you. You got to go to the head wall to get that type of action." And it's the same thing here. Like, by the time everybody hears about this and is jumping in, it's almost like you need to be asking yourself the question, if I'm way outside this market and someone just told me to buy $500 of XRP, what's the chance that I'm late to the deal? You know what I mean? It's probably pretty high.
Pretty late, yeah.
Yeah.
Well, I mean, there's all, but before people get all too wrapped around the axle, there's short-term late and there's long-term late. Nobody in any of these markets are long-term late. I think we're long-term early on everything. the ones
I
that are
would
going to
agree.
succeed. So you have to, I mean, I always talk about the product that I think will get the most interest on the retail side, ex Bitcoin, will be L1 infrastructure indexes that constantly
Right.
rebalance so that you put
Right.
your money in and you're always getting the top ones. And so as new ones come in, you get there. And that's kind of like the moral equivalent. Why is it the S&P is so damn popular and it's done so damn well? Well, because it's always rebalanced.
We
right?
did a show on Tuesday with Matt Haugen.
Oh, yeah,
And
perfect.
one of the points that was made is like, okay, just Bitcoin ETFs are just unbelievable performance. Like nobody predicted any of this.
Mhm.
But my guess is at worst 3 years from now, the second largest pocket of Bitcoin of ETFs and crypto are going to be a basket of cryptos that people
Right.
decide.
And that's my point. I think I heard parts of that show.
Well, because it's not that, there's no version, there's no massive Microsoft ETF or no massive Google ETF.
Why wouldn't
Those exist associated with the S&P 500 or the QQQ, right? Like you and I were around when QQQ came out. It was all over the business shows for like
QQQ was the
5
black hole
years.
of investing. It sucked all the light away from individual stocks
Yep,
for so
it sure
long.
did. Sure did.
It was a very, very big deal. And
But
you
even
know,
QQQ, when it came out, like in the first couple of years, 3 billion, 6 billion, whatever, nothing like Bitcoin. So that's the point, is that 3 years from now, it's still going to be Bitcoin at the top. The next will be like a grouping of Solana, Ethereum, and something, and something, and something, and then whatever it is, like the top 10 that aren't Bitcoin. And it'll probably have a version of Bitcoin in it, right? Probably have,
I think that's certain.
Bitcoin.
I think that's certain. But the thing to keep in mind, and it's what's interesting, is in the world of equities, don't underestimate the impact of the Qs, because the Qs, it wasn't just the assets under management. It was the number of growth managers that effectively were closet indexed to it. And so it ended up, they didn't own the ETF, they could buy stocks. So they would buy the basket of stocks that would mirror it or be very close to it. And then they would deviate where they made their choices. I used to spend most of my formative years building program trading systems. And so trust me when I tell you that indexes have a very important, far more than just the ETF size, in the way financial markets are shaped. And the same will be true in crypto by, I think, within 3 or 4 years. I don't know when,
I would agree.
but I do know it's going to be a very big deal.
Well, let's shut it down. I believe we all have lives and families to get to. 6:15 here on the East Coast, so I got to show my face to my significant other and my children. So yeah, great discussion. Interesting to see what the price action looks like tomorrow, but most interested in Monday and onward. Thanks, guys. Appreciate the time.
Yeah, it was fun.
You
See you
bet.
guys.